wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets, and we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 218. And in this episode, we're reviewing the performance of the financial markets during the 25th week of 2026. And that is from Monday the 22nd to Friday the 26th of June. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where the Federal Reserve's preferred measure of inflation rose to its highest level since 2023, reinforcing expectations that the central bank may consider hiking interest rates later this year. According to a report from the Commerce Department that was released on Thursday, the headline rate of inflation, as measured using the Personal Consumption Expenditures Price Index, showed that inflation was running at a seasonally adjusted annual rate of 4.1%, which was the highest rate since April 2023. And excluding food and energy prices, the core Personal Consumption Expenditures Price Index showed inflation rising at an annual rate of 3.4%, which was in line with the Dow Jones Consensus estimate, but was the highest core inflation rate since October 2023. The Fed generally considers core inflation as a better measure for longer-term inflation trends as it strips out volatile food and energy prices, particularly in light of the recent spike in energy prices due to the ongoing conflict in the Middle East. On Wall Street this past week, the Nasdaq Composite posted its fifth consecutive losing session on Friday as investors rotated out of key technology stocks and into more defensive areas of the stock market. AI-related stocks were weaker on Friday after a New York Times report said that OpenAI was considering delaying its IPO to next year following SpaceX's poor performance after its debut and the overall volatility in technology stocks. The tech-heavy Nasdaq Composite fell by 4.6% during the week to close at 25,297, whilst the S&P 500 slid by nearly 2% for the week before stopping at 7,354, and the 30-stock Dow Jones Industrial Average outperformed during the week as it rose by 0.6% before eventually settling at 51,876. In the government bond market, the yield on the 2-year Treasury note took a dip on Friday after one of the Federal Reserve presidents, who is a voting member of the policy-setting Federal Open Market Committee, said that he had changed his outlook and now thinks that at least one interest rate hike will be necessary this year. The yields on U.S. Treasuries were trending lower this past week as global energy prices declined, reducing the expected future impact on fuel prices and consequently also inflation. In response, the yield on the 2-year Treasury note, which closely tracks short-term Fed interest rate decisions, fell by more than 3 basis points to close at 4.08%, whilst the yield on the 10-year Treasury bond, which is the benchmark for mortgages, auto loans, and credit card debt, fell by 2 basis points to settle at 4.37%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, oil prices continued to decline on Friday as more tankers exited the previously blocked Strait of Hormuz, easing supply concerns despite one of the tankers coming under attack in the Gulf of Oman. The decline in oil prices came as investors closely monitored developments in the Middle East while assessing whether recent diplomatic efforts would reduce the risk of disruptions to the supply chain. In response, the price of the international benchmark Brent crude fell by about 4.3% to close the week at $71.99 a barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, declined by 3.7% to finally settle at $69.23 per barrel. And this was the first time since the 27th of February that U.S. crude has closed below $70, which was the day before the Iran war started. In the precious metals market, the price of gold edged higher on Friday, but was still on track for a fourth consecutive weekly decline. Gold appreciated on the back of a weaker dollar, contrary to expectations of higher U.S. interest rates following the latest price data, which showed inflation at its highest level since 2023. According to the CME's FedWatch tool, traders are pricing in about a 60% chance of a U.S. rate hike in September. Meanwhile, gold saw a modest rebound on Friday after coming under selling pressure earlier this week. Higher interest rates and tighter monetary policy tend to reduce the appeal of non-yielding assets like gold. The price of gold hit more than a 7-month low earlier this week, and prices were still down by 2.6% for the week as spot gold came to a close at $4,073 per ounce. In the cryptocurrency market, on Wednesday, Bitcoin dropped to its lowest level since October 2024 amid a pullback in tech stocks as the crypto bear market continues to drag on. The price of Bitcoin slid more than 4% to hit a low of $59,023, which was its lowest level since October 2024. This was the third time this year that Bitcoin has traded below $60,000. The flagship cryptocurrency is in its 8th month of a bear market and is being squeezed from both macroeconomic and industry-specific headwinds. Capital has been rotating into AI stocks, hot IPOs, and prediction markets, and a broader loss of confidence across the crypto market has led investors to question Bitcoin's unique value proposition. The primary upside catalyst for the broader crypto industry is the market structure bill known as the Clarity Act that has about 5 weeks to clear a key legislative hurdle before Congress breaks for summer recess. And over to the African financial markets, where on Tuesday, Nigeria's Securities and Exchange Commission ordered an immediate halt to the marketing of a purported initial public offering by Dangote Petroleum Refinery, saying that no application has yet been filed or approved. The Commission said that no application for the registration of an initial public offering of shares of the Dangote Refinery has yet been filed or approved by the Commission. The Securities and Exchange Commission also warned that the promotions, including requests to pre-fund accounts or secure allocations, could mislead investors, distort market expectations, and undermine market integrity. And in other news on the African continent, according to a Reuters report, Standard Bank Group and Industrial and Commercial Bank of China have been authorized by the People's Bank of China to clear renminbi transactions across Africa. This move will give businesses on the African continent direct access to China's onshore financial system. The authorization establishes the two banks as the renminbi clearing banks of Africa, enabling them to jointly provide clearing services for the renminbi across 19 African countries. This move is expected to simplify cross-border payments, lower transaction costs, and improve the efficiency of trade and investment flows between Africa and China by allowing businesses to settle transactions directly in the Chinese currency. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.63 compared to a rate of 129.55 that was recorded the previous week. Meanwhile, the sterling pound was priced at 170.63 and the euro was valued at 147.05. And on the regional front, one Kenyan shilling was changing hands for 28.61 Ugandan shillings and 20.21 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.30. Despite the war against Iran and the subsequent increase in fuel prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been staggered between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased marginally by $24 million for a grand total of $13.17 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged around 16.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 25th of June, and the central bank received bids totaling to 28 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 117%. The central bank accepted 17.4 billion shillings, and the results of the auction were as follows. The 91-day rate was flat at 8.82%, whilst the 182-day rate crept up by 7 basis points to settle at 8.84%, and the 364-day rate ticked up by about 2 basis points to average out at 8.99%. Please note that over the past few weeks, the Treasury yield curve has been rising steadily, and this is mainly on the back of the first supplementary budget for 2025-2026, which increased the domestic borrowing target to 996 billion shillings. In addition to that, the latest data shows that inflation is trending higher, and this is mainly driven by rising fuel prices due to the ongoing conflict in the Middle East. And as a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the impact of inflation. In the primary bond market, during the past week, the Central Bank of Kenya announced a top sale for the 2 reopened fixed coupon treasury bonds, in which it was looking to raise an additional amount of 20 billion shillings. The auction for these 2 bonds was held on Tuesday, the 23rd of June, and the central bank received bids totaling to 31 billion shillings against the advertised amount of 20 billion shillings, representing a performance rate of 155%. The central bank accepted a total of 29.2 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2018 and now has 11.8 years left to maturity, the central bank accepted 6 billion shillings at a weighted average rate of 13.98%, compared to the bond's coupon rate of 13.20%. And for the second bond, this was a 25-year bond initially issued in 2021 and now has 20 years left to maturity. The central bank accepted 23.1 billion shillings at a weighted average rate of 14.86% compared to the bond's coupon rate at 13.92%. Up next is our topical issue, and this week we're looking at two issues. The first is the IMF urging the central bank to align policy meetings with data releases. The International Monetary Fund has urged the Central Bank of Kenya to consider aligning its policy setting meetings with the release of quarterly national accounts data in order to ensure timely and accurate analysis and forecasts based on the latest available economic data. The Central Bank's Monetary Policy Committee currently holds its policy meetings at least once every 2 months, which works out to 6 meetings a year, but retains the option to hold more meetings if the need arises. The IMF observed that the central bank holds 6 policy meetings per year, whilst the Kenya National Bureau of Statistics publishes quarterly economic data, but with a delay of 1 quarter. For example, the release of the first quarter national accounts data for 2026 is expected at the end of June 2026. The idea to align the central bank's policy meetings with the release of quarterly national accounts will ensure that analysis and forecasts are reflective and responsive to the current economic conditions. And the second topical issue is on the central bank establishing a link with Clearstream. The Central Bank of Kenya has announced the establishment of a link with Clearstream, which will provide international investors with efficient access to Kenyan government securities supported by the central bank's Central Securities Depository, better known as the DAO CSD. Please note that the Kenyan link will be the 60th domestic link within Clearstream's global network and the second in Africa after South Africa. Clearstream's connection to the DAO CSD will provide foreign institutional investors with access to the domestic bond market through a unique omnibus account structure that supports Kenya government bonds, infrastructure bonds, as well as treasury bills. In this regard, Standard Chartered Bank Kenya has signed a deal with the Central Bank of Kenya in which it will be responsible for the purchase and safe custody of government securities on behalf of the international investors. Standard Chartered Bank will serve as Clearstream's correspondent bank for Kenya shillings and the domestic custodian for the Central Bank of Kenya. The bank will also act as an intermediary for foreign investors and their banks, handling roles such as currency conversion, payments, and the purchase of government securities. This move is a significant milestone in the development of Kenya's financial markets, and this link is expected to deepen liquidity, broaden the investor base, and enhance resilience of the domestic debt market. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, never put off until tomorrow what you can do today. A quote by Thomas Jefferson. Think about it. Thank you, and God bless.